Welcome back. We're going to finish up Chapter 12 by talking about the last two segments of ratios that help us understand the health of a company. Remember, ratios is not about remembering how to divide one thing by another, and it's not even just about knowing where to find the pieces of information, though that is going to be a vital skill in ratio analysis. The bigger thing is, what do we do with the information? What does it mean? How do we interpret it? So hopefully, if you want to, you can even replay the previous video so that you can remind yourself of how to actually interpret some of this data. Let's move on to asset efficiency. Asset efficiency and the ratios that we're going to calculate now are going to help us answer the question, how efficiently does a company use its assets in operations? If you've been in the business program long enough, or if you've been in business, or if you simply just like to study these kinds of things, then you know that efficiency is a big deal when it comes to business. We want to use our resources as efficiently as possible, and so these ratios will help us measure especially a word that you may not use a lot outside of the dessert world, and that's something called a turnover. They're going to help us measure a turnover. Now, this is not a fruit-filled pastry, sadly, but it is something that's kind of useful. A turnover ratio helps us measure the number of times per year that any asset is consumed. And actually, if you take a turnover ratio and you use it to divide by 365, you discover that you can determine the average number of days that are required for assets to be consumed. So a turnover ratio will usually be some number greater than 1, hopefully. And that'll tell you how many times per year that particular asset account has been consumed. And in general, the more times per year that a company turns over an asset, whether that's inventory or some other asset, the happier we are. We like our turnover values to be higher. However, if you choose to take that turnover number and use it to divide into 365, you want to end up with the fewest number of days possible. I want high values for the turnover, but fewer days. Because what I want to know is that it does not take me very many days to turn over that particular asset account. So more times per year or fewer days. First one I'm going to look at is called accounts receivable turnover. That helps me understand how many times a year do I get paid back all of my accounts receivable. How many times does my accounts receivable balance go all the way down to 0? Okay, Cornerstone 12.6 asks us to determine that for Aeropostale. Now, if you notice, you are going to be dividing by average accounts receivable. In order to come up with an average, you will have to go to that company's balance sheet, find their accounts receivable, which, oops, this is Aeropostale, and they don't sell anything on credit, nor do they go into debt, so I'm not going to have any accounts receivable. But if I did, in order to find an average, what I would do is take 2 years' worth of information and divide by 2. That would help me understand what their average accounts receivable is. But since they don't have any accounts receivable, what am I going to eventually realize? Yeah, we're dividing by 0. So it turns out, Aeropostale, we can't measure their accounts receivable turnover. So let's move on. Inventory turnover. Now this is going to tell me how many times per year do I clear out the company's inventory account. Well, if you're in a retail business like Aeropostale is, I hope that they are moving through their inventory pretty quickly. I want them to turn over inventory rapidly. So if I have the information of cost of goods sold as well as average inventory, I can find that out. Where do I go to find cost of goods sold? Not the balance sheet, but the income statement, right? So let's find out. Their cost of goods sold is not stated as such on their income statement. How do you see it here? Yes, it is called cost of sales. Same thing as cost of goods sold, just so you know. Now let's just look at 2010. And I see that cost of goods sold is, let's see, this is in thousands, right? So 1.4 billion. I'm rounding a little bit here. 1.4 billion. So you'd plug that into your calculator. And then you need to find out the average inventory amount. Well, I'm going to have to look at 2 years worth of inventory. Merchandise inventory. I see these are the 2 years worth. In order to get the denominator in this thing, I'd have to take the 132,915, add it to 126,360, and divide by 2. And that would be my numerator. Excuse me, that would be my denominator. If I had done all that, I would have realized that Aeropostale is turning over its inventory 10.67 times per year. About 10.5 times a year. If I take 365 and I divide it by 10.67, what I get is 34. And that would actually be telling me that's 34 days. Aeropostale clears out its inventory closets 10.67 times per year, which means every 34 days. Now, what was it in 2009? Well, they were turning it over 9.37 times per year, or the equivalent was every 39 days. So, was 2010's inventory turnover better or worse than 2009's? Asset efficiency ratios, I want them to be higher in terms of their turnover, but lower in terms of days. Well, 2010, they turned over more times, and they did it in fewer days each time, which means 2010 was the better year. We also have something called an asset turnover. Essentially, how often do I consume my assets? Well, I'm going to go to the income statement to find out net sales. And remember, net sales means is net of, what is it? Net of all the sales, discounts, and returns. Right, so after everyone returns all their too small or too big hoodies, we had net sales in 2010 of 2.2 billion. And I want to divide that by the average total assets of the company. Well, what were the average total assets? It's going to be 2 years worth of total assets divided by 2. If I did that math, I would discover that Aeropostale was consuming all of its assets on average 3 times a year, which means every 118 days it consumed all its assets. In 2009, it consumed its assets 3.22 times in the year, which was the equivalent of every 113 days. So, was Aeropostale more efficient at consuming its assets in 2010 or less efficient? Was it better in 2010 or was it worse? It was a little bit worse. Remember, we want the turnover amount to be higher and the number of days to be lower, and it did neither. The last category of ratios is dealing with profitability. Why do companies exist? Well, one of their reasons is to stay in business. And if they want to stay in business, what do they need to be? They need to be profitable. So some of these ratios are going to help answer questions like, how does the company's operations lead to a profit? How does the way it makes investments relate to how it makes a profit? One of the things you're going to discover is all the profitability ratios that we are going to learn will be answered as percents, not 1 point something or 10 point something or so many days. It's all going to be percents. And in profitability world, the higher, the better. First ratio we're going to look at is something called the gross profit. Now, where do I find the gross profit account? Which financial statement? That's right, the income statement. Where do I find net sales? Yep, that's right, the income statement. So, I'm going to head to the income statement to find out what was Aeropostale's gross profit percent, or, by the way, in accounting world, the word margin is often substituted for percent. What was its gross profit margin? I'm going to go over to the income statement, and we're just going to look at 2010. And I'm going to say gross profit was $847 million divided by net sales of $2.2 billion. Well, if I plugged that into my calculator, I would discover that Aeropostale in 2010 had a gross profit margin of 37.99%. Now, what is that actually saying? Well, in English, what that says is for every dollar that it made in sales or in revenues, it still had 37, almost 38 cents left in gross profit after it dealt with cost of goods sold. You know, now if you actually wanted to know from this piece of information what was the cost of goods sold, well, I can say that for every $1 in sales, we were left with, let's just say 38 cents in gross profit. That means 62 cents of COGS was used that year. For every dollar of sales, there was 62 cents of COGS and 38 cents of gross profit. Just want to show you how these ratios can actually translate into more than just what they seem. Now, in 2009, Aeropostale's gross profit margin was 34.69%. Was 2010's gross profit better or worse than 2009? Exactly. We want our profitability percentages to be higher. And in 2010, Aeropostale's gross profit margin was higher, which means it was better. Second ratio we're going to cover in profitability is the operating margin, or operating percent. And what I'm essentially wondering is for every $1 in sales, how many dollars in income from operations did it have? Well, chances are it doesn't have dollars left. It has some amount of cents left. We're going to get a percent, right? So we're going to find income from operations, $382,685,000, and we're going to divide that by net sales of $2.2 billion and change. If I plug that into my calculator, I'm going to discover 17.16% is Aeropostale's 2010 operating margin. So, 2009, what was it? It was 34.69%. Was it better or worse in 2010? Yeah, it was much worse. Now, it was better when it came to gross profit margin, and now it's worse when it comes to operating margin. Let's just go back and let's just see. Gross profit was nice and healthy in 2010 compared to 2009. But, what happened here? Yeah, we had a higher expenses there. So, looks like as these things go, they simply didn't do as well on their selling, general, and administrative expenses. All right, another ratio, net profit margin, or sometimes just called profit margin. Now, people should be precise when they say things like this, but sometimes they'll drop the word net. But you should assume if they don't say anything else, they just say profit margin, you should assume they mean net income divided by net sales. Before I go any further, I'm just curious, did you notice that all of these are numbers that are on the income statement and then they are divided by sales? If I did vertical analysis of a common-sized income statement, wouldn't I have found the exact same thing? Everything on a vertically analyzed income statement would be divided by sales. So, can you find some of these ratios by doing some of the other analysis that you've already talked about? Yes, you can. All right, let's find the net profit margin for Aeropostale in 2010. Let's see, net income was $229 million. I'm going to divide that by sales of $2.2 billion. I plug that into my calculator, and what do I come up with? It was 10.29% net profit margin in 2010, and in 2009 it was 7.92%. Was it better or worse from 2009 to 2010? Got a little bit better. Exactly. Now, there are a few other ratios that we can look at when it comes to profitability. There's something called return on assets, or sometimes we refer to that as ROA. It's a little bit more complicated. We're going to take net income, and then we are going to add interest expense that has been multiplied by 1 minus the tax rate. Now, why do we do that? Well, because remember, you don't pay taxes on every dollar of interest that you have to expend, and so there's a little tax advantage to interest, and we reduce the total interest expense. In this particular ratio, we reduce the interest expense by the amount it saves us in taxes. So it's going to be net income plus interest expense times 1 minus the tax rate. And we're going to divide that by average total assets, and if you recall, the way to find the average would be to take 2 years of total assets and divide by 2. All right, so we have net income plus interest expense. This is Aeropostale. Aeropostale has no interest expense because it has no debt. So it turns out this nicely complicated little ratio, not so complicated when it comes to Aeropostale, is it? And then we are going to divide by the average total assets. So it's net income plus interest expense of 0 times 1 minus the tax rate, so it doesn't even matter what the tax rate is because it's just net income, divided by the 2 years worth of total assets divided by 2. And what we find is that for 2010, the ROA for Aeropostale was 31.65%, and in 2009 it was 25.51%. That means for every dollar in assets the company was producing in 2010, about 31.5 cents of net income, and in 2009 about 25.5 cents of net income. Every dollar in assets produced approximately 25.5 cents. So, was the company's ROA better or worse in 2010? It was a little bit better because for every dollar in assets, it made about 6 cents more. That's actually not bad. Lastly, we have something that is very popular to talk about in both accounting and finance world, and that's return on equity. There we take net income, once again, net income being a very important number when we're thinking about profitability because it is the bottom line of the income statement, and we're going to divide by average equity. Net income, $229 million, approximately. And we're going to divide by average equity. So I'm going to take 2 years worth of equity right here, and I'm going to divide by 2. If I do that for 2010, I discover that the company's return on equity was 58.12%. That means for every $1 in total equity in this company, it generates approximately 58 cents in profitability, 58 cents in net income. For 2009, the profitability in terms of ROE was 54.11%, which means it made 54 cents on every dollar of equity. So in 2010, was the company's ROE better or worse? A little bit better. Overall, what we discover is that in terms of profitability, Aeropostale was more profitable, by and large, in 2010 than it was in 2009. For every dollar of equity, for every dollar of assets, for every dollar of sales, on almost all counts, this company was more profitable in 2010 than it was in 2009. That concludes our second video, as well as Chapter 12, at least for us. You do have an assignment that will allow you to work through some of these problems. And in our next in-class session, we will actually be looking at a real company, Apple Incorporated. For those of you who are Apple or Mac fans, we'll be looking into their financial statements and comparing them not only to themselves, but to some other companies in the industry. I hope you've enjoyed. Have a great day.